Okay, hello, and today I will keep brainstorm about reading 43, and today I will keep continue to talk about reading the 43.2 about corporate bonds. And first of all, there are four questions about this loss. And the first question is with which of the following features of a corporate bond issue does an investor most likely face the risk of redemption prior to maturity? A. Serial bonds. B. Sinking fund. C. Term maturity structure. So for this question, we need to understand about the term of the answers first. For example, for this one, we need to understand about sinking fund. So sinking fund uh, is that with a sinking fund, the issuer must redeem a part of the bond prior to maturity. And of course, with this way, the investors do not know which bonds will be redeemed, and yeah, but we know the date, maybe like in 2019 20 million bonds will be redeemed, but we do not know exactly which bonds will be redeemed. So this is a very for this kind of way, is kind of risky because we do not know we will be redeemed or not. So, but let's talk about the second way is serial bonds. So serial bonds is kind of bond that we have a series of maturity. So we have like for example, my company, I want to issue 10 billion bonds, but I will start to issue 10 million bonds this year, and I will issue 20 million bonds next year, and keep continuing uh, to the next year. So with these serial bonds, we will know exactly which bond will be redeemed. So we in this way we don't actually we use this like is on maturity instead of redeem, but it actually is a way how to redeem the bonds. But in this way, with serial bonds, the investor know which bond exactly will be redeemed. Okay, so this one is redeem serial bonds. And next one, we talk about term maturity structure. Term maturity structure is if a bond that do not have a series of maturity, so we call this one is term maturity structure. So all the bonds have the same maturity date. Okay. So with a bond with bonds that have the same maturity date, we call this kind of bond is term maturity structure. So based on the explanation of the three kinds of um, bond issuing, we can know that which bond have the most, which way of issuing have the most risk is a sinking fund, because sinking fund, the investor can redeem the bonds in a specific date but without knowing which bonds will be redeemed, so it's very risky. For example, if I buy bonds and I do not know when my bonds will be redeemed, it's very dangerous. It's very dangerous, because like if I know when my bonds will be redeemed, I will have a alternative investment on my money, on my bonds. Okay. Okay, the next question is about like financial instruments. So the question, in which of following statements describe that if a cash flow to bondholders increase if in a specific reference rate increase, a participation instrument, B about capital instrument, and C is about yield instrument. Instrument, yes. So to talk about the structured financial instruments, we have basically we have two kind of very common. One is asset-backed securities, and we also have collateral debt. So collateral debt, for these two, I think everybody understand about about asset-backed securities, and we also know about collateral debt. So we will talk a little bit more about some types of structured financial instruments. First of all, we will talk about the yield enhancement instrument. So for this one, and capital protected instruments. For these two, I think I need to dig out more about these two, because I actually do not have much knowledge about these two types. Okay, the next one, I think I will talk about the participation instrument. A participation instrument is that will be paid securities with payments that depend on the returns on asset. We understand about return on asset. For example, like you have an asset like a machine and to make products, and you can get, okay, after a year how many profit you can get from that asset. So that means with a participation instrument, we will, the security, the payment for the security will depend on the return on asset, or on index, or it also may depend on a specific reference rate. For example, a floating rate note. It depends on LIBOR reference rate, maybe for this one. And the next one we have leveraged instrument. For this leveraged instrument, we have that the coupon rate will be varies inversely with this specific reference interest rate. This one is kind of like the inversement of the participation instrument. So for this leveraged instrument we have here is kind of is the same with like inverse floater. Like if the reference rate increase, the reference rate increase, then the coupon rate will decrease. And if the reference rate decrease, then the coupon rate increase. So it's kind of contract with the participation instrument. Okay, so for this question, based on the question is if a cash flow to the bondholders increase when the reference rate increase, that a floating rate note. Okay, so okay, next question, last but not least question. The last question is in a repurchases agreement, the percentage difference between the repurchases price and the amount borrowed is most accurately described as A, the haircut, B, the repo rate, C, the repo margin. So for this one, in a repo agreement, the percentage difference between the repurchase price, the purchase price, the repurchase price, and the amount borrowed is most accurately described as so for example, we have a bond that is selling in the market for 1,000, and now I lend it to investor with 800, and then I will repo this bond with the price 850. So now they want to ask the percentage difference between 850 and 800 is called or described as the haircut, the repo rate, or the repo margin or margin. So I know that so because I know that like the difference between the market value price and the market market value price and the borrowed price is called haircut or called repo margin. So for the difference between the repo price and the borrowed price is called interest repo. Yes, this one is kind of very difficult. I think you know it. Is it difference between repo price and borrowed price? Okay, let me talk again about this one, about repo. So repo is if repo, for example, I have a bond, for example Sally bond, and this bond is selling in the market is $1,000 per bond, and now I want to I will lend this bond to an investor with the price 800. Okay, so 3 months later I will repo this bond from the investor with the price 850. So there are 3 different numbers here: 1,000, 800, and 850. So the difference between 100 and 800, we called this one, so we called this one the haircut or the repo margin. Okay, so the next difference is the difference between the repo price and the borrowed price. So like from 850 and 800. So we calculate this one, we can have the repo rate. Okay, repo rate. And now people can ask me, like, what about the difference between the number 800, 850 and 1,000? So in the book they didn't say about this one. So I'm not so sure about what is this code for the 850 and 1,000 differences. But remember that repo rate will depend on so many factors. For example, we have repo term. Repo term is long, so repo rate will be increased. And the next one will be credit quality of the collateral. If the quality of the collateral is low, it's very low, so of course the repo rate will increase. It's easy to understand about this one. Okay, the next one is about delivery requirements. If you deliver the bonds into my hand, then the repo rate will be decrease, because I know exactly that you have these kind of bonds. Okay, and the next one we have market, the yield or interest rate for alternative sources of fund. If the interest rate of the alternative resources of fund increase, so of course the repo rate will increase. And the next one we have S and D condition collateral. If the demand on buying these kind of bond increase, of course the repo rate will be decreased, because a lot of people, they want to buy my company's bond. So of course I need to reduce the repo rate to the investor. So that's it for today. Okay, next I will keep working on reading 42 and 43, but in this in the curriculum book, in previous brainstorm, I talked about the reading 42 and 43, but in share book. But today I will talk about reading 42 and 43 again, but the questions will be taken in these curriculum books. Okay, so the first question is about defining elements. It's still reading 42. Okay, so we have there are some like calculation questions, but I will skip this kind of questions and we'll do the theory questions first, and then for the calculation questions I will do it later. And for these kind of questions, I think I need to like focus on calculating, not like talk like that. When the questions is about like kind of theory questions, I will talk like this, because I will express my understanding about the question. But for the calculation questions, I need to think about the formula, how to calculate that, etc. Okay, so now we started with the question number 4. The legal contract that describes the form of the bond, the obligations of the issuer, and the rights of the bond holders can be best described as a bond: A, covenant; B, indenture; C, debenture. So for this one, like before in share books, I already talked about this one. So for a contract between a borrower and a bond issuer, we call this kind of like contract will be called as covenant. Covenant is kind of, but if someone do not like, maybe we can, if someone who is good at English, they will know that covenant is the same with the word pact. So pact is also mean kind of a contract. So in this one we will talk about covenant. Okay, and why we do not choose the answer indenture? So this kind of contract will be called as indenture, but only in the US and Canada. So if for the whole world or for international, we call this kind of contract is covenant. Okay, the next question is, which of the following is a type of external credit enhancement? So we know external credit enhancement. External is something behind the corporation. A, covenants; B, a surety bond; C, over collateralization. So I think this one is collateration, over collateralization. Okay, the next question is affirmative covenant is most likely to stipulate. So, A, limits on the issuer's leverage ratio. B, how to proceed the bond issue will be used. D, the maximum percentage of the issuer's gross assets that can be sold. So for this one, we understand affirmative covenant is something the issuer must do. And negative covenant is something the issuer must not do. Must not do. Okay, so for this one, A, limits on the issuer's leverage ratio. This one is must not. No. B, how the proceeds of the bond issue will be used. C, maximum percentage of the issuer's gross assets that can be sold. So for this one, like we can take this kind of question to think about it, negative covenant and affirmative covenant. So affirmative covenant is kind of the issuer have to do something, must do something that the bond holders require. Okay, so for this one is like how the proceeds of the bond issue will be used. Okay, the next question is kind of very fast for this time because we actually brainstorm about reading 42 and 43 already. So but for this one is only in curriculum, but it's still something we need to understand more, because actually for share books doesn't like share book do not like include all the knowledge that we actually have to learn. Okay, the question number 7, which of the following best describes a negative bond covenant? The issuer is A, required to pay taxes as they come due. B, prohibited from investing in risky projects. C, required to maintain its current lines of business. So for this one, I think is the answer would be B, prohibited from investing in risky projects. Let me check it out, because actually we kind of like, okay, yes, like for negative covenants that prohibit the issuer from investing in risky projects, restricts the issuer's potential business decisions. These restrictions are referred to as negative bond covenants. Okay. Number 8. So number 8, we talk about some kind of bond name. Okay. The question number 8 is a South African company issues bonds dominated in pound sterling that are sold to investors in the UK. These bonds can be best described as A. Euro bonds. B. Global bonds. C. Foreign bonds. So for this one, we need to understand about what is Europe bond and what is global bonds and what is foreign bonds. So for this one, we need to understand about, first of all, we need to understand about what is domestic bond. Domestic bond is a bond that company issues in that country, in their own country, with their own currency. And so we call, and of course that company belong to that country, so we call this one is domestic bond. And the next one we will talk about the foreign bonds. Domestic. And then we have domestic, so we have international bonds. So inside international bonds we have foreign bond or Euro bond, and we also have global bond, and we also have Brady bond. So we have domestic bond, we also have international bonds, but in the international bond we have foreign bond, we have Euro bond, we have global bond, and we have Brady bond. But Brady, actually we don't need to learn this one in our subject, but we still talk about this one to just remember that in international bonds we have four kinds of different bonds. Okay, first of all we talk about the foreign bonds, or we can foreign bond. When we call a bond is a foreign bond, so for example Apple is the issuer, but Apple will issue the bond in Vietnam, okay, and with VND. So for this one, Apple is not Vietnam company, but Apple issues bond in Vietnam with Vietnam currency. So this one we call, if anyone buy Apple bond in Vietnam with Vietnam currency, so we call this kind of bond is foreign bond. Okay, country is not the company is not belong to the country, and I mean, if we can say that, okay, issuer different with the country, but the same currency, the country and the currency is the same, we call this one a foreign bond. Okay, the next one we have Europe bond. So Europe bond is kind of how can I say, Europe bond is the bond is issues by dollar, by dollar, okay, by US dollar, but outside of America. So that means like we have HAG, Hoàng Anh Gia Lai, issues their bond in Laos with US dollar. So for this case we have issuers different with the country and also different with the currency, and this one is we call Eurobond, because bond with dollar is issued outside of US, so we call is Euro bond. For even we issue a bond with US dollar, but in any country with that outside of the US, we will call that a Eurobond. Okay, so we have, there are some kind of names that okay, there are notes for Eurobond. Sorry, Eurobond is not Europe. Eurobond is Eurobond. Major is bear bond. Why we called that a Eurobond is a major, a bear bond? We know that bear mean bear mean not register, not, do not need to register. Okay, so bear mean owner. So that means in this kind of bond will not appear the owner name on the bond. So that means what we called Eurobond is a bear bond, because this kind of bond this kind of bond does not need to register with the government. Okay, so do not need to register with the government. Okay, as we know, the bear mean not register, bear mean owner. So that means in this in this kind of bonds, there are no name of the owner of the bond. So this one, okay, if you want to issue the bond, okay, Eurobond, fine. So it's kind of, we call that's what we call is a bear bond. Okay, the next one we talk about global bond. So global bond mean okay, so global bond, we talk about issue in both at least one domestic. Okay, for example, global bonds, I think global bond is, okay, I talk a little bit more about Eurobond. So Eurobond is issuers, countries, and currency is different. So global bond is about, global bond is mean you need to issue a domestic bond, and you also need to have a Eurobond. For example, VinFast will issue the bond. VinFast will issue the bond in Malaysia with ringgit. So this one we call, let me check it out. Okay, okay, talk about the global bond. I think so global bond is mean that we issue both like Eurobond market and at least one domestic bond, market. So for this one, I think to make sure that I understand about this one, I will check it out later. Okay, so for this question, a South African company issues bonds dominated in pound sterling that are sold to investors in the UK. So the bond for this one is foreign bond, because foreign bond, because the South African company and issue the bond in pound, it belong to you, is the currency of the UK and is trading in the UK. So this is called foreign bond. Okay, now let's remember just foreign bond. Foreign bond is mean just a company come to a country and issue the bond in that country with that country currency, with that country's currency. Okay, Eurobond is kind of like different issue, different with the country. The country also different with the currency. So we call Eurobond. Okay, the next one, the question number 9, relative to domestic and foreign bonds, Eurobonds are most likely to be bearer bonds, registered bonds, subject to greater regulation. Of course, a bearer bond, because we just talked about why Eurobond is called bearer bond, because like this kind of bond do not need to register, so we call bearer bond. Okay, the next question. Okay, an investor in a country with an original issue discount tax provision purchases a 20-year zero coupon bond at a deep discount to par value. The investor plans to hold the bond until the maturity date. The investor will most likely report a capital gain at maturity, b a tax deduction in the year the bond is purchased, c taxable income from the bond every year until maturity. Okay, for this one we already talked about this one. For the so we have like coupon rate, coupon interest. Okay, we have coupon interest and capital gain. So coupon interest will be taxed like ordinary income tax, and capital gain will be taxed as a income tax. Okay, so but the capital gain will be actually, the income tax will be lower than ordinary income tax. So coupon interest will suffer ordinary income tax, and capital gain will suffer capital gain income tax, and capital gain income tax will lower than ordinary income tax. So for this one, we talked about this before. If a discount or zero coupon bond, so we actually, the coupon is a discount bond, of course the coupon is very small, and zero bond is no coupon will be paid during lifetime of the bond. And so for this one, people say like, okay, there are no money, no cash flow come to the bond holders, so of course there are no tax will be taxed to the bond holder. But if we do like this, it's unfair for the people. If people they buy a bond with like premium bond, or or kind of like not really deep discount bond, because actually, okay, if like zero coupon, so for example you buy a bond with 900 and there's no coupon during 10 years, and after 10 years you got 100, and their capital gain is 10, so you only will be taxed $10 as capital gain. It's not fair for the people, because capital gain will be taxed less than interest coupon. So I think for this one, no, it's not A, not a capital gain at maturity. So we talk about B, a tax deduction in the year the bond is purchased, not this one. Taxable income from the bond every year until maturity. I think this one. Okay, let me check this one. Yeah, let's see. Because original issue discount tax provision requires the investor to include prorate portion of the original issue discount to his taxable income every tax year until maturity. Yeah, this one we talked about is before. Okay, the next one we will talk about is if interest rates are expected to increase, the coupon payment structure most likely to benefit the issuer is A, step up coupon, B, inflation linked coupon, C, cap in flow note, a floating rate note. So for this one we talk about, okay, if interest rate expect to increase, the coupon payment structure likely benefit to issuer is, that means if the interest increase, okay, if the interest increase, so what kind of coupon payment structure will benefit to the issuer? A, step up coupon. Step up coupon means the issuer will pay like before it prior to maturity. Okay, so cap in floating. So I think like step up is just about like if you have money you just pay for it, but inflation linked coupon is not, like it's depend on the inflation rate. So see, cap in floating rate note, it means that if a cap in a floating rate notes applying to this one, it means it doesn't matter how much the interest rate increase, but the issuer will not pay above the cap. So see the answer of this one. Okay.